In a nutshell, it's about near-term inflation. It's not just the price of, say, petrol itself, but higher shipping costs for imported materials, all sorts of things that rely on shipping, which I guess is most things we bring into the country.
Kia ora, and welcome to New Zealand Property Market Podcast, brought to you by Cotality for the 9th of March 2026. I'm Head of Research Nick Goodall, and today I'm joined, as per usual, by Chief Economist Kelvin Davidson. Kelvin, I want to cover off potential implications of the geopolitical tensions around the world later, but perhaps to lead us in there, let's review the performance of the market in February via the Cotality Home Value Index. Now, this did show a small rise over the month in property values. It was a little bit of a surprise to us, although you did mention that, a sort of flat-ish to slightly rising last week when we look at the weekly results. Do you want to take us through the data, though, some of those details below the surface of the nationwide figure, and also how your release went to media, mate?
Yep, so 0.2% increase in the national median value in February. So, it's a bit of a rise. It's not off the charts or anything, but a wee bit of a rise there. I guess a bit of a different trend than what we've seen over the past 2 or 3 months. So definitely worth taking note of. Definitely not also, on the other hand, worth going overboard about. But I suppose, like I said to a few journalists, upturn starts somewhere. It always starts somewhere. So you've got to be definitely keeping an eye on it, and particularly with we know interest rates are down, economy's turning around. So it's definitely something to take note of. I think the thing more so than that national rise, because it's still fairly small and it's probably within the error margins and could be reversed next month. We still seem to be in a pretty cautious environment. I think probably more so than that number itself, the thing that struck me was probably more the fact that it was more broad-based. So across all of the main centres, there was actually an increase across all of those main centres in February, and that wouldn't have happened for quite some time because Auckland had fallen 8 or 9 months in a row prior to that. So we haven't seen, I guess, that more broad-based figure for quite a while. And so, Auckland wasn't up much. It was only 0.1%, but, it's some sort of rise. But you go through to Christchurch was something like 0.6, Dunedin and Hamilton were 0.9. So I suppose it was that broad-based nature of it that was most striking to me. There was still growth in, the old favourite of Invercargill. It went up again. Some growth in some other provincial markets that I've forgotten right now, maybe Gisborne, for example, I think. So, there was a bit of a broad-based nature to it. Not everywhere, but it did seem to be spreading just a little bit. So I suppose, don't go overboard, don't ignore it. That's kind of the message I'm left with. And just the fact that, when interest rates have fallen over the past couple of years, the economy is showing signs of turning around. You would think at some point there is a bit of scope for growth in house prices, and maybe that's started to turn now. Like I say, I wouldn't get ahead of yourself, but you can't ignore it either. So that's kind of my overall take on it. Spoke to a few journalists. The media didn't go crazy about it. I think there was probably bigger fish to fry last week in terms of what we'll talk about shortly in terms of global issues. But there's a wee bit of interest, and I suppose people will be taking note of it. And I guess we'll wait and see what happens next month.
Yeah, for sure. No, I think that's a really good point, and I agree in terms of that. It was important because of that broad-based nature, the strong growth in some of those areas. We talked in the past about how obviously Auckland has a pretty strong influence over the nationwide figure. So the fact that Auckland was slightly up just led to the others being able to have that influence over the New Zealand one. But I think it was important for that reason. As you said, don't get carried away. We never, get too carried away with 1 month's data. But even over the quarter, NZ figure was slightly down over the quarter, 0.1%. So let's call that flat. And Auckland was the one dragging that down. Auckland's still down 0.8% over the last 3 months, but all others were up. And again, I think that's just an illustration that you would probably have moved into some form of new phase. Yes, we'll talk about this shortly, but these recent geopolitical tensions and things going on may well create a stutter to all this change in the market or potential change in the market. But I do think that it's significant for the fact that it wasn't just further declines or mini declines, which effectively we've been calling flat for a few months anyway. So I do think it was significant from that purpose. I did just quickly bring up the the article on our website, which I think is worthwhile for others to go and check it out as well. It's quite a nice little summary of this. Obviously, it's the article that you write, but it does have those charts people can go and flick through too, whether it's those main urban areas, the main centres themselves, the detail behind, say, the Wellington or the Auckland figures too. And you can look at monthly, quarterly, annual change from peak, median value over time as well, or right now as well. It's worthwhile going and looking at those ones. And yeah, you're right. The monthly change for Invercargill was 1.1%. It was Wanganui that was 1.2% over the month, and Gisborne at 0.9%. Again, we do see some volatility below the surface at some of these areas month to month, so sometimes the quarterly figure is worthwhile looking at. And for those that are only slightly up, Invercargill 1.9% up, so a bit more consistency there. Wanganui 1.3%, Gisborne 1.1%. They are the strongest performers over that 3 months. But yeah, as I say, go and look at all the data as well. The details are all there on the website. I'll make sure to leave a link there. You can look at those annual figures, and Invercargill up 6% over the last year, for example. So yeah, worthwhile going and checking out all that detailed data. I'm glad to hear the media didn't go too crazy about it either. You obviously did a good job in writing that article to ward them off, I suppose, that, yes, it's worthwhile noting these things, but not getting carried away at the same time. And who knows the influence of more recent things as to what happens in the future over the next couple of months, I suppose, anyway. But yeah, I think that's probably all to cover off with that. As I said, all the details there, so go and check it out, and you can download that detail as well. But the charts are quite nice to play around with, so do go and check that one out. But let's talk about that. I suppose for the economic update this week, let's talk about the conflict between US and Israel with Iran, and obviously the potential impact here in New Zealand. Some pretty broad things going on here, and we're not going to get too political or detailed about this. I don't think, certainly not my expertise, and I know you have a pretty decent understanding of this, but probably not fully in your wheelhouse either. But we do try and relate to what it means for New Zealanders. I suppose in the simplest form, it's likely to increase inflation here, particularly for oil and petrol prices at the start, because the strait there has been shut, and so transport's been impacted by that. But as those broader things, they're all impacted by fuel prices as well. I know there'll be some conflicting turnarounds maybe in some costs, which I'll allow you to go into. I think there's going to be a big thing depending on how long this goes for. Short term, if it can get resolved sooner rather than later, maybe the impact over the longer term won't be quite as bad, but disruption and uncertainty is never a good thing for the global economy, and that's going to flow through to here as well. I did see an interesting post on X from Kelly Eckhold from Westpeak Economics team, and he'd sort of talked about some work they've done with the Oxford Economics global macro model, particularly looking at the difference between New Zealand and Australia when it comes to the fact that, we don't actually export any energy here in New Zealand, but they do in Australia. So they get the ability to, I suppose, offset some of the terms of trade, that if people are using less oil and it's costing them more, they might use some of the energy that Australians export, but we don't get that same ability here in New Zealand. So it will have an increased impact on our inflation here in New Zealand, to the point where they sort of even say, CPI inflation could increase by 1.6 percentage points, which is quite high. And then, of course, this impact of our economy reducing by the potential of about 0.5 percentage points as well. So, while we're just starting to see our economy grow, this could limit that growth and also push up inflation. So, from the Reserve Bank's perspective, and that's who I want to hear from, because they're the ones that really matter here, they're obviously less likely to drop the OCR, which we never expected anyway. But does it maybe increase the likelihood of that OCR increase coming sooner rather than later, when we're expecting that, lift in November? There was chat prior to all this going on about it maybe coming further forward to September. Maybe that's more likelihood of that happening even further forward if we do see this disruption really strong in the shorter term. I know the Reserve Bank focus on medium term, but they still might need to get ahead of this if it's going to have some longer term implications. So yeah, that's where I think, that's where my head goes. I'm definitely just reading others' opinions here and trying to take that into my own understanding and then try and pass that on. Do you want to give us your take, mate? You're probably more clued into the global economics side of things here and where you see things at. Maybe if you've had some conversations with media or in some presentations in the last week, sort of what your take has been and how we can help others to understand this better, to help them make smarter decisions.
Yeah, possibly. I mean, I'd back myself to in a sort of debate or a panel discussion about property data itself and what's going on the property market. Have direct opinions on that. I'm probably to some extent poaching information from others when it comes to geopolitical and sort of macroeconomic stuff too. But I mean, in a nutshell, for me, it's about sort of near term inflation. Yep, that seems, I mean, almost guaranteed. We're already seeing inflation right now. I mean, look at the price of petrol the next time you go past the petrol station. That's already there. So inflation's already coming through from that energy side of things, as well as it's not just the price of say petrol itself, but higher shipping costs for other things, imported materials, all sorts of things that rely on shipping, which I guess is most things we bring into the country. So there's going to be that impact as well. And some of the notes I've been reading, it's not just so much sort of petrol prices itself, but you factor in the refining margins because we take a lot of our imported petrol is apparently refined through parts of Asia, Singapore, for example. So if those refiners there are pushing up their margins, that's going to feed through as well. So it's not just the higher cost of raw materials, in this case the higher cost of oil itself, but then for us as importers, the margins that other people in that supply chain are taking too. So yeah, quite a potentially concerning impact there, given that Q4 inflation was already at 3.1%. You add on a percentage point or a percentage point and a half to that from this petrol price shock, energy prices in general. That's pretty uncomfortable in terms of that overall CPI number. So that's already here. I mean, now we can debate how long's the near term and how long's the medium term and how long's the long term. These are very moving targets and very uncertain sort of timeframes. But I think the near term we're already seeing that inflation impact there. But of course, this is pretty much a tax on most households. You're paying more for petrol. That's basically a tax because everyone sort of has to pay for petrol. So, that's going to mean less spending elsewhere. You can't buy that coffee or go out for dinner or whatever it is because you're diverting more of your income towards that petrol. So, yes, there's inflation there, but there's also disinflation in terms of wider activities in the economy. Maybe in those sectors, people might not necessarily be cutting their prices, but they might have otherwise been planning to push through a price increase that now they can't because they're conscious of consumer spending on their good or service will be reduced a little bit. So there's that impact as well as medium term. You think that as you've alluded to, we're not we don't really benefit so much from higher energy prices if there's slower global growth, shipping problems, global uncertainty, more awareness of risk. That is going to be negative for our economy in terms of GDP growth and production. So medium term, now again, how long that is up for grabs, but medium term slower economic growth will pull inflation back down again. So I think really the key thing coming out for me from all of this is simply how long it lasts. And yes, there's obviously a human cost to this as well, acknowledging all of that. But from a sort of financial markets and an economic perspective, it's really about how long it lasts. And can this really short term, near term inflationary impact from higher energy prices, can that sort of just simply wash out if we see the conflict come to an end and those prices come back down again. So that's really what it's all about. But even if it does hang around for a bit longer, then you've got that other impact, as I say, which is the slowdown of our economy through uncertainty and all those global shipping problems, that sort of thing. So yeah, it's near term versus medium term, how long it lasts, all of these things. I think in terms of what the Reserve Bank does right now, probably nothing because they're aware that they're looking at the medium term for inflation. They've been pretty clear that they think there's still spare capacity out there that should eventually pull inflation back down again. Yes, it could be a bit uncomfortable in the near term if we see say these higher oil prices hang around. We see Q1 CPI inflation go up, rather than what they thought was coming back down. So that's going to be an interesting balancing act, and I guess an interesting sort of communication to see what they say about that. So there's all of that. I think right now, really, all they can do is wait and see, watch how it plays out, and yes, they'll be watching very closely. But I don't think we'd be expecting to see any sort of knee-jerk reaction in terms of a near-term OCR increase, for example. I think that's probably still well off the table. It's about sort of just assessing where we are. Watching and waiting, I guess, and then seeing how it all plays out, how long it lasts. Again, I guess is the really key thing. But the longer we have inflation above target, the Reserve Bank will be really concerned about those inflation expectations. If people see higher oil prices, they tend to extrapolate that forward and start to think, well, inflation will always be a little bit higher. So then they factor that into their pricing decisions and all of that. So it's probably those inflation expectations that the Reserve Bank is really concerned about. We're keeping an eye on that. So yeah, what for now? Watching and waiting. I don't necessarily expect we'll see any change from the Reserve Bank straight away, but certainly the longer things stay like this, the longer it goes on, the longer inflation's high, then yeah, the chances of an OCR increase sooner rather than later do increase because they have to try and keep inflation in their target. So yeah, but keep in mind spending more on petrol, there's less spending elsewhere. That's going to be disinflationary, as well as the wider impact on our economy, which will be to slow it down. That's going to be disinflationary. So it's not as if it's all kind of one-way traffic on that inflation front. And the Reserve Bank can so-called look through a temporary spike in inflation, but again, it's how long it lasts. That's the thing, and nobody really knows right now. So watching and waiting, really.
Yeah, for sure. Yeah, I think you've got to a really good point there as well around the Reserve Bank and how much they don't like to panic on these things, how important stability is for them, and them raising interest rates in the short term is not going to be a good thing for financial markets for sure. So I think yes, stability will be the key thing in the short term, and I don't expect any change. Next time they meet, which will be in a few weeks' time, I guess, just for the OCR decision, not for the full statement, of course. But we'll get a little bit of an insight from their take on this, and I think that's a really important one to wait and read as well. But otherwise, yeah, I think it's a good well-rounded view as well, Calvin. That there are these things that do balance and provide something that might be a drag on inflation at the same time. So it's not all going one way. Do you have any other thoughts on, say, like exchange rates and things? I've read a little bit more stuff about how, when these things happen, there's a flight to safety. That's often, to things like gold, which has had its own volatility recently as well. But also there is this flight to the US financial markets, which has boosted their US dollar, which in turn reduces the value of our dollar. The impact that can have on our economy as well. Is there anything else you can sort of take us on some insight when it comes to the exchange rate and how that might flow through to economic growth or otherwise?
Yeah, for sure. I mean, the exchange rate's interesting in terms of two sides of the same coin as well, the importing and exporting side, because we have actually seen the New Zealand dollar's gone down, and that's all to do with that sort of flight to safety. People go for the big, strong, global currencies. Our little New Zealand dollar tends to get forgotten about a little bit. So I think the exchange rate has fallen, which of course adds to the inflationary pressure from higher petrol prices. You buy the same amount of petrol, but your New Zealand dollar doesn't get you as much. So that adds to inflation. On the other hand, of course, a lower New Zealand dollar is great for exporters, and so it will tend to push up export returns for things like dairy exports and sheep meat, that sort of thing. So again, it's how all these things weigh up against each other, and so yeah, lower dollar not good for that near term inflationary impact, but will tend to be good for our GDP growth, for our economy. So again, I think that's a bit of a balancing act too. Probably just how long this thing lasts for, and I mean currencies are so sort of volatile anyway and hard to predict. So you wouldn't necessarily want to go too strongly in either direction on that exchange rate in terms of planning. I wouldn't think, because it can shift so quickly. So that's a bit of a tricky one. But yeah, right now we've seen the dollar go down. So I guess really near term, if we focus on what we know right now, is that petrol prices are higher. That will be exacerbated by a lower New Zealand dollar. That will add to a bit more inflation. So that is just the uncomfortable truth right now, is that we're starting from a point where inflation's already a bit too high. This will only add to it. So yeah, there'll be some sort of shifting on their seats at the Reserve Bank, I would imagine. But keep in mind that medium term, and they do have capacity to just wait and see. So hopefully that's what's going on.
Yeah, I think so, and I think that's probably the immediate point to take, is that the next one's probably going to be just hold for stability's sake. Then we'll wait to see for that forecast when they do the next monetary policy statement and give us their full take on everything. And hopefully this conflict has advanced to a position of less conflict, hopefully even past that. But yeah, as I say, that's the big uncertainty here. We do not know how long this goes for, and that'll have huge impact depending on whether it's 1 month, 3 months, or even longer. And then then it'll be really interesting to see how everything's playing out. We'll get a bit more data as to what's actually happening, as well as then start to be able to hear those decision makers gut feel or their expectation on how that's going to impact things longer term as well, and then of course how they're going to react to that. So yeah, I think we're going to give this some more time. Wake up every day hoping to hear better news, but yeah, it hasn't exactly been great so far. Whatever we are, 9 or 10 days since things kicked off. So yeah, let's hope for some better news. On that front, from an economic perspective, we did get some, I suppose, as we've previously seen, and these things will not be impacted at all by the recent conflict, we have started to see some better data come out around the economic recovery. In particular, last week we saw some, better signs from, or continued good signs of growth in dwelling consents, as well as filled jobs starting to increase as well, or continue that increase as well. Did you want to just go through that data at all, as much detail as you like, I suppose, as to how those dwelling consents and jobs are going, because we know how important the labour market and of course that construction sector, which has been playing a pretty strong part in this recovery, how they're going, and again how that might play out. All the other things aside, let's look at those local factors right now.
Yeah. So a couple of good results really. It just adds to that sense that the economy is turning around. We had dwelling consents pretty solid in January, up 15% year on year compared back to the previous January. It was the seventh rise in 8 months, so I guess just continues that pretty clear upwards trend now that we've been seeing for a while. The annual total is up to around 37,000, so that's a 2-year high. So good news. It's not as busy as it was maybe 3-4 years ago, but 37,000 dwelling consents not too bad in a long run context, and so points to more actual house construction coming through. Obviously, this is an early stage; it's just at the approval stage, but get more consents, you're going to get more houses down the track, so that's good from a from a builder's perspective, from an economic growth perspective. Construction's a pretty good contributor to overall GDP, as well as housing affordability. With more houses, whichever style they are, whether they're standalone or townhouse, whatever, just more houses in general will keep more of a lid on house prices and support that affordability, that improvement that we've been seeing for a while now. So good result there, and filled jobs up 0.2% in January. So again, that's a good result. It's a wee bit patchy. These numbers can be prone to revisions, and December's number was actually down 0.3 from memory. So, you're down 0.3, you're up 0.2. It's a wee bit patchy in terms of these jobs figures, but when you sort of smooth it out, you put it on a chart, you sort of look back a little bit, you can just start to see a bit of an upwards trend there, and that's what people are expecting. The Reserve Bank's definitely saying in their forecast that we think employment has troughed and should start to trend a little bit higher. That will help bring down the unemployment rate. So it's maybe not emphatic yet, but it looks like we're there. So a bit more jobs growth coming through. Some of the surveys are saying that firms are feeling a little bit more confident about hiring as well. So there's a few more job vacancies out there, a few more job adverts, situations vacant or whatever they call them. There's a few more of those out there. So just suggests a bit more confidence coming through. It might not be booming, but that's again that idea that upturn starts somewhere. I think we're probably seeing that in the labour market now. So good couple of results there. Dwelling consents better, jobs better. So winning.
Yeah, I like your word there in terms of it's not emphatic, right? Like, yes, it's improved, it's better than it was, so we can be happy about that from a jobs market perspective anyway, but it's not emphatic. I like that word, like it's not exactly like things are storming away. We can't say we're in the clear yet. The economy's better and it's performing better than it was, but, we're not in a strong growth phase here, and then you talk about those uncertainties from the global conflict, and it just keeps that with that, I suppose that, that level of concern or consideration for, hey, things aren't all gravy right now, but certainly better than they were. And I think that cautious attitude, that cautious mindset is probably a good one that's going to prevail at the moment as well. Like, things aren't storming off, but certainly better than they otherwise were. And so we've got to be positive about that, but also not get carried away and think that, everything's fine and dandy and are going to continue to grow from here. On the dwelling consents too, good point. I think I like the way you touched on affordability there, building more of these and becoming more affordable. Just reminded me that, of course, we do have the affordability report coming out this week. So we sort of release this every 6 months. This is for Q4 last year. And we have seen some improvement in affordability, which we've been talking about for a while, whether it's here in these conversations or in presentations as well. So it won't be a surprise to everyone out there. But the report will be fully out this week as well. And so again, all the details available there to get right down to your city, your town. So do go and check that report once it's gone live. I think that'll be on Wednesday. It'll be available to public. So keep an eye out for that one this week. But Kelvin, that's pretty much a wrap, I think, for property and economic discussion today. So for listeners that's all you're here for, then the links for all the stuff we've spoken about will be in the show notes below, and we'll certainly be catch up with you again next Monday. But before we do head off, Kelvin, I don't think we can sign off today without covering off the Black Caps from this morning in the World Cup final. Disappointing, though maybe not an overall surprise result. I did manage to get up at 2:30, lasted about 3 hours. I think we were 5 down before I thought, no, I'll try and get a couple of hours extra sleep at about 5 o'clock-ish. Did you get up for it? Any strong takes on this one? How's your disappointment levels? Another World Cup final missed?
Yeah, no, I set my alarm for 4 a.m. I thought I'll assess kind of at the halfway point, and I had in my mind, if India's batted first and they've put on 250, I'll probably, flag it and go back to sleep. And as it turned out, that was pretty much what happened. So I did sort of drift off. But the annoying thing was I kind of had it in my mind then. I was half awake and I was thinking, maybe they're going all right. Maybe I'll just check. So there was always that uncertainty. I probably should have just got up and watched it, even though we know the result didn't turn out that well. But yeah, I don't know. I obviously want New Zealand to win. My favourite is always Test cricket, though. So the fact we won that championship a few years ago, that's still good enough for me. But yeah, you always, when you're in the battle, you want to win, of course. But as you say, I think for me, it probably went the way you thought it would. No massive surprises, but still disappointing. So yeah, on to the next one, I guess.
Yeah, I tell you, it was a hard watching their batting, but I always held that hope that you can't judge until both teams have batted. So, knowing the form we had in that semi-final with both Seifert and, of course, Phil Allen got all the headlines, but Seifert actually was the aggressor early on in that semi-final. You always thought there was a chance if they got off to a similar start. Would we score 170 odd in 13 overs against South Africa? Now, I'm not saying, India's bowlers, or certainly South Africa's bowlers are better than India's or anything. So it was always going to be a difficult one. And that turned out to be the case, and that's why once we'd lost both those openers, we still had that little bit of hope once Seifert was in and he scored a decent 50 odd. But once he was gone and we had to rebuild the innings and we still had 180 to score or something, it was looking, very unlikely. And yeah, just tough to take. It's another final. I agree with you. Like, tests are where my head's at mostly. And T20s are generally not the Black Caps' best form. They're very good at the 50 overs. They've shown they can meet the best at the tests as well, but they seem to turn up for the finals, and so it's just hard that they get to another final, have a chance to really compete, and I don't know, maybe missed a few selections. Maybe they should have gone with a few more slower bowlers. Again, all in hindsight, I'm sure. But yeah, just another one tough to take. And the powerhouse that is India, it did feel like it was all sort of in their hands. That was all sort of shifted towards them winning it throughout the tournament. So yeah, and they got some incredible players. There's no doubt about that. So yeah, look, 130,000 people in that stadium's pretty crazy stuff. It was very blue. But yeah, so in the end, I suppose you didn't miss much and probably better off for your extra sleep. But while there was hope, I was hopeful I was going to be seeing something historic, but wasn't to be. It would have been cool to be the men's T20 champions at the same time as being the women's T20 champions, but we'll have to be happy with just the women's at this stage and wait for the next one. At least they come around every 2 years, I think, for the T20s, so it's not as long to wait. But yeah, oh well, they'll be disappointed, but what can you do? But that is pretty much us for today, mate. Anything else on your mind from anything's perspective?
No, that's all good. Yeah, bit of reporting to be done this week, but yeah, watch out for affordability on Wednesday. It's yeah, I think tells an encouraging story.
Yeah, no, agreed. Yeah, good tease. We'll get that one up within the next couple of days and talk about that one in more detail next week. And I got another trip to Auckland this week too, so looking forward to once again some good productive meetings and conferences to speak at as well. So no doubt get plenty of questions on that conflict as well. So it's good to tease out a few thoughts today ourselves, and no doubt we'll talk about that more this week. But look forward to catching you, those of you out there who are at those conferences. But that'll pretty much do us for today. Thanks, Calvin, as per usual, for your insights. I was obviously keen to get the download on that conflict and the potential impact here. So thank you very much for your thoughts on that. But otherwise, I want to say thanks very much for listening. Please do get in touch with any questions or feedback you have for the show. Really always keen to hear about those ones. But that'll do us for today. My name is Nick. He's Calvin. You've been listening to New Zealand Property Market Podcast. Mā te wā.